Hello and welcome to Truth Be Told. I am your host, Rosalind Levy of Levy and Associates with Keller Williams Chesapeake. On this episode, we are going to be joined with Angel Dodson, who is a mortgage lender. Meeting with a lender is a vital process when purchasing a home. So let's find out the truth about the money behind the purchase. So today we're going to be talking about lending. And first question, what do we have to do to actually apply for a loan? What are the requirements?
The first step would be to, find a loan officer that you trust, usually through your realtor. So having a realtor you trust first is important.
Absolutely.
Once you have your loan officer, it is important to get qualified for the actual amount that you're qualified for instead of just going out and looking for homes. You don't want to just go out and look for a house and find one that you love just to find out that you actually don't qualify for that home. So starting with a lender would be the first step in the process.
Awesome. I truly understand because we do not want to waste any of the lenders or agents' time.
Yes.
So what are some of the requirements to apply for the loan?
Requirements are we basically look for 2 years of employment history.
Okay.
We also look for 2 years of residential history. So we would want to see where you stayed, look for a positive on-time payment schedule for any rentals or mortgages or anything that you have. And then, of course, we look at your assets to see, what type of savings pattern you have, if you have any money saved. So those are the few requirements that we look for initially.
Okay. Do you have any first-time homebuyer programs that you can speak on?
Yes, we actually have a few. We have the Chenoa loan program. It's an FHA loan.
Okay.
The 3.5% down payment is basically set up like a second mortgage, but it's something that the customer will not have to bring. The good thing about that program is it allows for the seller to pay more towards closing costs.
Okay.
We do have other options like a conventional loan. We have Home Possible and Home Ready.
Okay.
It gives lower rates to the customer, a lower down payment of 3% as opposed to the 3.5% with an FHA. Lower mortgage insurance, so it's a lot of benefits that can help the borrower to purchase more homes starting off.
Okay. What about people with bad credit? Are there any programs out there that can help with bad credit?
When you say bad credit, that's, it just depends because anything can happen to anyone. You can have a life circumstance or something to happen that can impact your credit, but we actually go down to a 550 on FHA and VA. So, for someone that may have had small blemishes, it is still possible to purchase a home. So
Okay, I understand. So what about people like myself, a business owner? Do you have any programs for us?
yes, I do. Like you're saying, sometimes when you are a business owner and you file your taxes, you may have write-offs and you may not claim a ton of income.
Okay.
But we have options to where we can look at bank statements. So I have 2 different loans, depending on your credit score, to where we can look at the inflows from your business through your bank statements and qualify you that way. So, it's not based off of just your tax returns and what you're filing as far as your income. We can actually look to see what you're making monthly and over a period of time.
Okay, so basically what you're saying is not to write off everything.
Yes, if you are looking to get a standard loan through FHA or conventional and we have to, do the standard 3-year look back with your transcripts, you would want to have your taxes filed and have some income there. But if you're in a situation to where, you wrote off a lot and you don't have a lot of income to show, there are still options with that bank statement loan.
Okay, so I do run across clients where they have bankruptcy issues or been in a bankruptcy for a while, it's been discharged. Are there any programs out there for them, or is there even an option for them to?
There's what they call a seasoning period for FHA and conventional, so there's times that you have to wait. That same loan I was just speaking of, the bank statement loan,
Yes.
they have an option with no seasoning, meaning you could have just had a bankruptcy or, a foreclosure, and you still have the option to purchase a home. So it's not out of the question. There are higher requirements as far as your down payment and your credit score, but it's the option to still purchase even though you've had, some blemishes as far as maybe a bankruptcy or foreclosure.
Okay, is there a certain amount of time that they would have to wait before they apply?
For the standard FHA, there is a wait period. So if you've had a bankruptcy or Chapter 7, you have to wait at least 2 years from the discharge date.
Okay.
And also it's the same for VA. So if you're a veteran and you're looking to purchase and you've maybe had a Chapter 7, then you would have to wait the 2-year period. For conventional, it's a little longer wait period. It's 4 years for bankruptcy. And if you have a foreclosure, you have to actually wait 7 years. But there are ways that you can work around that and kind of go with the bankruptcy period. Okay. But, it's based on each customer or each borrower's situation.
Okay, so what if it's a Chapter 13? Can they actually purchase during that process?
How that works is it's actually a little more lenient, being that you're going to be making payments. So if we can show that you've done 12 on-time payments to the trustee or whoever has your, control of your Chapter 13, then there's options after that 12-month period to where you can still purchase. And like I said, or you can go with that bank statement loan if you have a higher credit score or, a little more to put down, you can purchase immediately.
Okay. Is there a minimum credit score with your company?
The 550 is the minimum we have for FHA and VA. We go down to 620 for conventional. So like the Home Ready and Home Possible I spoke of for first-time home buyers, if you have a 620, then you can do that 3% down payment as opposed to the 3.5% with FHA.
Okay, so what you're saying is if it's 580, they would not qualify for the Shanoa program.
The Shanoa program is actually a down payment assistance program. So when they give you that, down payment, they want you to have better credit.
Okay.
So we can do 620, with that program. We can't go down to the 550 like we can on the standard FHA, but we can do it at 620.
Okay, so what if they were to have a co-signer? Would that make a difference with the credit score?
Yes. Having a co-signer can definitely improve your chances, because if the co-signer has more income, that can get you more home. If they have better credit, it can reduce the risk of your loan. So, it makes it look better to the underwriter to have someone that would, sign for you and basically vouch for you to make the purchase.
So, do you offer any loans for luxury buyers?
Yes, we actually have a few different options. Luxury means, kind of like a jumbo loan. So the FHA and conventional and VA that we discussed before, they have max limits on those. So, generally depending on your county or area, in this area it's $484, $350.
Okay.
But we are able to go up to $3 million on different types of products we offer. One of the best we have is a 5% down, no mortgage insurance option, because you can imagine at $1 million how much mortgage insurance would be.
Absolutely.
So being able to eliminate that amount will help a buyer to purchase more home.
Okay. So can you explain a little bit about the jumbo loan? I know I'm an agent, I'm not a lender, and people out here really don't know it as well. So can you explain that a little bit or go into a little more detail?
Yes. So like I said, it just depends on the buyer. So if a person has 20% to put down to eliminate the mortgage insurance, that's wonderful.
Okay.
That would be the best option, because then they would have the lowest payment, the lowest rate, going into the mortgage. They wouldn't have the mortgage insurance starting off. Somebody that may not have 20% of $1 million or $2 million, that 5% down option may be the best option, because they come in with, lower money as a down payment, but then the payment isn't as large as it would have been, being that they can eliminate that mortgage insurance.
Okay.
So, it can make it more feasible for someone that maybe can purchase $1 million house. Now they can purchase a $1.5 million house because the payment is more affordable for them.
I don't know, I have so many clients out there that ask, hey, do you have anyone that can help me with my credit to boost my credit score up? So let's talk about that a little bit more and see.
Yes.
So what is it can we actually do to help them?
Okay, so usually when I run, one of our buyers' credit, what I'll do is I'll look at all three bureaus.
Okay.
I have different simulators that will say, if you pay off this, your score can be this.
Okay.
If you, eliminate this account, your score can be this. So we have a lot of different programs that we can look at. So even if the buyer isn't exactly ready, now we can get them ready and prepare them for purchasing in the future. So just giving them small things like, reducing a balance on an account or paying off an account, taking yourself off as an authorized user on maybe a family member's account, because then that you're basically liable for that debt as well. So sometimes doing things like that can boost your score tremendously. And having tools like that helps the customer, because I can send you all three of your credit reports. You can look at it. We can look at it together.
Okay.
I usually comb through and just, sometimes student loans may be a problem. So we have different options to where if you get an income-based repayment program, that can reduce the amount that you are obligated to pay monthly. So that's an option as well as far as the credit. A lot of times people just assume, my credit is bad, and then I pull it and it's not bad. Sometimes we just have a negative thought when we're talking about credit, and you may be a lot more qualified than you think you are. So like I said, starting with your lender is the first place that you shouldn't be on Zillow looking at this dream house. You shouldn't be out with a realtor on showings if you don't have at least a pre-approval letter to show that, we've looked at your finances, we've looked at your income, we've looked at all the debt you owe, and this amount is what you qualify for. So that's what's most important.
Okay. So I know you are not a credit repair lender.
Right.
However, what I usually do with my clients is once you give them that report, I would actually sit down with them, go over it with them as well, and tell them what they need to do as far as if they need to write a letter to the credit bureaus to dispute anything.
Yes.
Can you elaborate a little bit on that as well?
Yes. A lot of times, things can be in error. So just having that report can give you the tools and the power to really improve your credit. Like you're saying, if it's something on there that may have been not yours or old or something like that, you can always write into the credit bureau and dispute transactions, and they can be removed in a couple of weeks. They are really on it. It's every 30 days, they say, but I've seen them removed within a week once a dispute has been filed.
Okay. I know some situations are like if it's a junior, the son and the dad has
senior,
the same name.
A third, or it can be 5 James Moores, or just sometimes a digit off on your social can have something on there that's just not yours.
Right.
So paying attention and having that report is instrumental in knowing your financial situation, because you may think you're in a situation and find out that something is there that's not yours. So disputing it is the first step in getting that removed from your credit.
Okay.
Yes.
Well, I definitely would say to dispute it on your own instead of using a credit company,
because you can do it for
they're going to
free.
do the same thing, and they actually need your permission to write the letters. So why not write them yourselves?
Exactly.
If you can pay that credit repair company, then you can take that money and put it toward paying off whatever is needed.
And paying something down, and reducing your utilization, because that's really what they look at. If you have a $1,000 credit card and you have a $900 balance, that reflects negatively on your credit. No matter, it's not a large amount, but it's still, they're just looking at how much you're using. So you always want to, keep that as low as possible. And that's what boosts your score. If you have a $1,000 credit card and you use a couple $100 and pay it off each month, that will help revolve and boost your score monthly.
Okay. So again, I'm not a lender. Is it good to pay the credit card completely off to zero, or is it good to make monthly payments to actually establish your credit?
It's okay to pay it off. I wouldn't close it. Sometimes closing it is not good for your credit, because utilization is a part of it. History is a part of it. So once you close it, that history is cut off.
Right.
So, paying it down is the way to go. Paying it to zero is great, but using it is also good. Some people feel like, I have this $10,000 credit card and I never use it. But if you're not putting something on it and showing that revolving payment, then it's not going to help to improve, or it's not helping your credit, basically. So even if you just use it for something, you would use your debit card for gas monthly, pay it off, put a small balance on it and pay it off.
Okay. So what about situations where you have really good credit? Well, you have really good income, but you have zero credit. Do they have anything like traditional loans? Do they still have that out there where they may use your cell phone bill or your
Yep, we call that like a non-traditional trade line type of loan. So if you have no credit, sometimes that's better than having bad credit, because we can build your credit profile. Like you're saying, we can look at 12 months of rental history if you paid your rent on time. Anything you have set up on recurring payments, it can be your Netflix, it can be your auto insurance, it can be, cell phone bills. Anything that you're paying on time, we can look at a 12-month history most times and build your credit profile. So no credit is not a bad thing. We can actually work with it as long as you have some type of history we can track.
Okay. Well, thank you. Thank you for joining me on Truth Be Told. Until next time, be blessed.